So Cathie Wood just did a interview with CNBC International live from Abu Dhabi. I don't know why she was in Abu Dhabi, but nonetheless, she went to Abu Dhabi and she did an interview. It's about 3 or 4 minutes. We're going to talk about what she's talking about, her overall thesis, what her thoughts are, and ultimately how she thinks of innovation given her funds are not doing as well.
I want to ask you about some of the other markers in the market. I wanted to ask you about some of the other markers in the market right now, particularly as it relates to the war in Ukraine. Have we seen peak market impact yet, and what should investors be focusing on here?
It's very hard to say if we've seen peak market impact. I know the markets are getting hit today. Typically, the way we see the peak is through the VIX, the volatility index. And it has moved up. It's in the mid-30s. I'm not sure what this morning is. And the shock in 2018 and the one before that got us into the low 40s. Of course, the coronavirus got us to 80. But we're getting close to those cathartic moments in the past.
Notice she says in 2008 we got to the low 40s, and that's when we obviously had a recession. So like if the VIX is above 30, and that's the volatility index that measures how volatile the market is, if we get back up to those low 40 levels that we're peaking at, there's a world in which the market may be reacting the same way that it did in 2008, which could be the potential for a recession, which is why she's saying the risk of a recession has gone up dramatically.
I would be surprised if we do go to the coronavirus levels, because remember, people were expecting a depression. The whole world shut down. This is not that. This is going to cause a lot of problems from a purchasing power point of view. I think the risk of recession has gone up dramatically as purchasing power is dropping dramatically. In the U.S., the consumer saving rate already is down to levels we have not seen since 2013. So that buffer that the stimulus payments created during the crisis, that's gone. And so consumers are probably going to pull back. Sentiment suggests they will.
Now, this is actually good for her argument, because if consumer sentiment goes down because there's a fear of a recession, which means people are spending less money, just like they did in 2018 and obviously in 2008, then that means there's less money going into the economy. Why is that good? And why is there less money going to the economy? Because people are saving their money. They don't want to buy a $4 cup of coffee anymore because they're afraid of, spending money on little purchases like that. Purchasing power in and of itself decreases. Cathie's argument is that inflation is transitory, and she still believes in this, right? So in order for growth stocks to come back, inflation has to go away. How does inflation go away? People have to stop putting money into the economy. How do people stop putting money into the economy? Well, consumer sentiment and demand in general on a macro has to go down. So if that happens, that is actually good for her argument, which doesn't guarantee a recession, but it does guarantee at least people stop spending as much as they are right now, because the more people that are spending, the more inflation is just going to go higher.
In some ways, they already have. If you average over the last 3 months, this is U.S.
All right, that's the last clip, and this is the next 3-minute clip.
Let's talk about what's happening in the markets right now and what's happening in the fund, because, Cathie, it's been said that you are in the toughest battle of your career right now. Not only are you fighting against the market momentum, you're also trying to halt huge losses and outflows. So I want you to address this for us. What is the message to investors here? Do you think that the street is just getting you wrong, or is it time to concede that mistakes have been made?
So let's put in perspective. You mentioned 60%, which is absolutely right. We have been in a terrible bear market for innovation. Hard to understand, but terrible bear.
So I kind of find it weird when she says hard to understand. There's 2 levels to analyzing that statement, right? When she says it's hard to understand for why we're in a bear market for innovation, the logic I'm assuming she's going with is, well, these stocks are innovating. Technology is technology. So why would anyone not want to own technology stocks that are innovating? Because, technology is the future. So, why would you not want to own a Roblox or a Zoom, et cetera, et cetera? Those are just examples of stocks. But if these stocks are innovating and people are using these stocks and they have real revenues and they're growing, why would you not want to use them? But on the flip side of that, it's weird she says that, because it's like, these stocks are valued on what they can do in the future. And if the future is volatile, the future is risky, we don't know what's going to happen in the future. That's the whole reason why innovation is down, why growth is down. If interest rates are going to go higher and growth stocks are only able to grow by borrowing money and going for market share and not having profits, which means they need to borrow money, which means they need to pay more to borrow capital, because the cost of borrowing capital goes higher because interest rates go higher, that means valuations intrinsically have to get compressed because the value of your company has to be less than the value of it is today, because you have to pay more money to make the same type of profits that you would make in the future. So, like, it makes a lot of sense why innovation is down right now, given high inflation, given supply chain problems, and given everything going on in the macro. I think she's betting on in the future it doesn't make sense for innovation to be this low, which is why it territorializes this concept of a deep value territory for her stocks.
Fair market for innovation. However, if you look from the bottom of the coronavirus to that peak in February of 21, we were up 358%. Why? Because innovation solves problems, right? Now we're down 60%, and we have a whole new set of problems, certainly coming out of Russia and Ukraine. If you look at our strategy over a 5-year period, look at the last 5 years, I'm not quite sure what the numbers are, but they are well above our minimum hurdle rate of return, which is 15% at a compound annual rate. And I think over 3 years, we're closer to 25%. So that helps put our performance into perspective. You know, this is a period, if you believe in innovation, and that innovation does solve problems. We had a preview of that after the COVID crisis when our strategies.
So a couple things there. Number one, she says like we've gotten a compounded annual growth rate, a CAGR of around 15%. She has publicly said she can get a 40% compounded annual growth rate over the next 5 years. I think, you know, that's like most people are like, that's just not going to happen. So that was kind of like, and when you say stuff like that, you know, it hurts legitimacy sometimes to trust you, because if you're promising, and she said this in December, we will get a 40% CAGR because of how deep value these stocks are, it's like, well, that means that ARK has to go up 40% this year, and it's like most funds don't go up 40%. Now, granted, she's saying, well, innovation solved problems in 2020, and we had a preview of that. The problem she's not mentioning is that, you know, we had Fed liquidity in 2020. We had stimulus checks in 2020. We had people stay at home, which is why like Zoom kind of exploded in 2020. So it's just to add a little more context. Again, I'm not bearish against ARK. I'm not bearish against the stocks. I'm not like, oh my God, Cathie's like insane. It doesn't make any sense. I believe her fund will grow. I believe innovation stocks will come back. The question becomes, are they going to come back to the level at which they were in 2020 when there was liquidity, stimulus checks, people staying at home, et cetera, et cetera. And she has to be absolutely 1000% correct that the actual technology within these stocks is so innovative that it will bombast people to these new levels. Because now when investors buy growth stocks, when growth comes back, I don't know if they're going to pay the same rich valuations for any regular growth stock, right? Like, is a Roku going to go back to $450 or $380 at its peak because it's part of being innovative? Or is it actually going to get evaluated in terms of how innovative is it? How much is it actually growing? And that's the ultimate question. It's not that ARK is not going to come back. 5 years from now, ARK absolutely will come back. The question is at what level and how innovative will those companies ultimately be?
In the span of a month, many of the stocks were taken down 75% because either they were burning cash or they had low cash cushions. But guess what? Those were the genomics companies that were going to get us out of the coronavirus. And today, what do we have? We have all kinds of problems, the latest of which is Russia, Ukraine, and all of the commodities coming out of that area, especially hitting Europe. I think we're going to be looking at a lot of demand destruction and substitution into innovation. Electric vehicles as opposed to gas-powered vehicles would be the biggest one. We also have labor shortages all over the place. Again, automation. This is innovation at its best, and it's being turbocharged by this environment as the market is really hitting our stocks. So I think if you were to look at the next 5 years, and if you were to give us that 5-year investment time horizon, we are the closest you'll find to a venture capital fund in the public equity markets. If you were to give us that 5 years, given our expectations for growth in these new technologies, I think we're going to see some spectacular returns.
So let's talk about that real quick. Couple of final things I want to say on that. Number one, she says, look, you got to give us that 5-year time horizon, and if you give us that 5-year time horizon, we will perform well. And I think that makes a lot of sense, right? If you're investing in ARK, if you're investing in growth and innovation, you have to believe that in those 5 years there's something meaningful going to happen. What's going to happen in those 5 years? Well, she's saying all of the money that's right now being allocated to like gas and oil and all that stuff's going to die out, which means if it's going to die out, there has to be a return on that capital. Where are investors going to put their money to be able to get a return on that capital? It's not going to be gas. It's not going to be traditional stuff. It's going to have to be what we're doing. EV, growth, innovation, genomics, all this type of crazy stuff, which means the ARK funds should be able to benefit off that. And then the final thing she says that's like super interesting is this idea of being a venture capital fund. A venture capital fund is, for those who don't know, an institution that raises billions of dollars and allocates it to a ton of startups. And, you know, they're looking for the next Instagram. They're looking for the next Twitter. They're looking for that next startup that has such massive growth that it returns, you know, billions and billions of dollars. Coinbase was given $200 million by Andreessen Horowitz, which is a famous venture capital firm in California. And they returned $10 billion when they went public. So, I mean, like, they made that venture capital firm a lot of money. Those returns are not 1x, 2x, 3x, 5x, 10%, 15%, 8% S&P average. Those are almost 100, 200, 300x returns. I mean, those are very, very big returns. So when she says we're the closest thing to a venture capital firm, she's saying, look, I know growth is getting hit right now, but if you give us these 5 years and you trust us, we're going to give you some returns that are quite astronomical at the end of the day.